BanglaPulse.
Welcome to the Deep Dive. Today we are undertaking, well, a massive legislative autopsy, really. It's the complete overhaul of Bangladesh's income tax system.
That's right.
This isn't just about, updated forms. We're diving into the official English text of the Bangladesh Income Tax Act of 2023. This thing effectively replaces the entire decades-old framework of the Income Tax Ordinance of 1984.
Yeah, it's a huge legal shift. And for you listening, our mission here is to kind of move past the surface noise and really understand the core reasons for this structural reset.
Okay.
We need to grasp why the old law couldn't just be amended, what crucial adjustments were made almost immediately after the new act passed, and maybe most importantly, what critical, sometimes pretty surprising definitions now dictate who pays what in this autonomy.
Okay, let's unpack this right from the beginning then. Before we even touch tax brackets or income sources, we have to start with this almost hidden constitutional history lesson. It's right there in the Act's preamble. Why did the government have to repeal a nearly 40-year-old tax law instead of just, modernizing it?
Yeah, this is where the story gets legally quite complex. The need to repeal wasn't really driven by financial policy initially. It was driven by a judicial decree.
A court ruling.
Exactly. The Supreme Court, in Civil Petition 48/2011, ruled that the martial law itself, specifically the 1982 to 1986 Martial Law Proclamation, was unconstitutional.
Right. And since the Income Tax Ordinance, 1984, was brought in during that unconstitutional martial law period, well, it was legally flawed from the get-go.
Precisely. You see, when the 2011 constitutional amendment dropped paragraph 19 of the fourth schedule, that paragraph had sort of previously validated those martial law ordinances. The whole legal basis for the 1984 tax law just evaporated.
Oh, okay.
So this 2023 Act isn't just a reform. The government was basically legally compelled to write a completely new law, in Bangla originally, mind you, to kind of clean up the constitutional record.
Wow. So they weren't just fixing a bad law. They were legally forced to replace an invalid one. That completely changes the context of this whole reform effort.
It really does.
And the force of this new legislation, it seems absolute. Section 3 talks about the overriding effect.
Oh, it leaves absolutely no room for doubt. The law states, and I'm paraphrasing slightly, regardless of what any other law says right now, the rules in this act will prevail.
That elevates the Income Tax Act 2023 pretty much above all other conflicting laws in the financial space.
Exactly. And if another law contradicts this act, it's considered void just to the extent of that inconsistency.
That grants incredible legal supremacy to the new tax code, a very strong position.
Operationally, though, the Act's stated objectives are fairly straightforward. Modernize the law, establish better financial discipline, and significantly expand the scope of enforcement.
Right.
It specifically mentions wanting to systematize rules around things like advance income tax, minimum tax, tax collected at source, surcharges, basically bringing everything under one clear umbrella.
Now, here's where, the implementation gets a bit messy and fast. Despite this massive effort in 2023, the Finance Act of 2024, which just became effective July 1st, 2024, made some significant structural changes right out of the gate.
Yeah, that was quick.
Talk about agile legislation or maybe just, necessary refinement on the fly. What were the most critical immediate adjustments they had to make?
Well, it looks like they needed to clarify some terminology and lines of authority almost immediately. Take the administrative authority shift, for instance.
Okay.
For key definitions like approved gratuity fund and approved superannuation pension fund, the approving authority got shifted. It went from the central board, that's the NBR, down to the local commissioner of taxes.
That seems like maybe a tactical move. Perhaps to decentralize some of the compliance burden, maybe speed up approvals for employee benefit funds.
That's likely the thinking, yes, exactly. Another really critical terminology change involved financial entities. The general term financial institution was systematically swapped out for the much more specific finance company pretty much everywhere in the Act.
Okay, does that narrow the regulatory focus? Maybe it excludes certain state-owned financial bodies? Or is it just a linguistic cleanup to align with other laws?
It's largely about precision, I think. It aligns the tax definitions more closely with the country's existing laws for the non-banking financial sector. By using finance company, they're clarifying they mean entities specifically regulated under those financial institution acts. It probably makes cross-regulatory enforcement much cleaner.
I see.
They also tidied up some smaller cross-references, like updating the mention of the old Customs Act 1969 to the new Customs Act 2023, just keeping things current.
Right. Makes sense. Let's turn now to the absolute core,
Hmm.
the definitions. You said 93 definitions in the preliminary section. That's exhaustive.
It is.
So for you, the listener, we really need to spotlight the crucial and maybe unique clauses that fundamentally change who and what is taxable. Let's start right at the foundation. Clause 13, defining income. What makes this new definition so different from the old ordinance?
Well, okay, beyond the standard stuff profits, gains, receipts, the most, I'd say, surprising, potentially radical inclusion, which was actually inserted via that 2024 Finance Act, is the explicit coverage of the acquisition of any asset.
Wait, hang on. Taxing the acquisition of an asset, not the income generated by it, but the acquisition itself. That sounds like a huge shift in tracking unexplained wealth. How do they justify that?
Well, it seems designed precisely for that, to capture unexplained wealth right at the point of acquisition. The idea is if you acquire an asset and you can't reasonably explain where it came from, like it wasn't from natural causes, inheritance, a documented purchase, then that acquisition itself can be taxed as income.
Wow. That significantly broadens the net for tax recovery.
Mm.
It really shifts the burden onto the individual to prove how they lawfully got the asset. It's quite aggressive.
It is, definitely. But you have to note the specificity, too. They did carve out clear exceptions for assets you acquire naturally, like finding something, or self-created assets, or things acquired through foreclosure or inheritance, will bequest, trust, exchange, purchase.
Okay, so standard, legitimate ways are excluded.
Right. They seem to be trying to be surgical in targeting unexplained enrichment while, respecting basic transactional law.
Okay. Yeah. Let's move to people. The definition of an employee, Clause 25, also substituted in 2024, is also, well, highly expansive. It covers the standard workers, obviously, but who else does it pull in?
Yeah, it specifically ropes in directors, managing directors, and crucially, any person performing management duties in a company or business, irrespective of their official designation. So if you're effectively exercising management control, you're treated as an employee for tax purposes. This often simplifies how taxes related to remuneration are handled and potentially recovered.
So even if your title is senior advisor or something vague, but you're functionally running things, you're now legally defined as an employee for tax remittance. Interesting. But then there's a very noticeable exception, a really targeted carve-out. Seems like social consideration.
Indeed. The definition specifically excludes any worker of a tea garden and also day laborers.
Right.
This means the compliance and remittance rules tied to the employee definition just don't apply to these groups. It simplifies the administrative side for employers dealing with highly seasonal or typically low-wage workers.
Okay, moving to residency. The criteria for an individual to be defined as a resident, that's Clause 45, seem very precise now. What are the two tests?
The first test is simple enough. You spend 183 days or more in the country during the income year. Straightforward.
And the alternative?
The alternative test is what catches people who might try to avoid that simple count. You qualify as resident if you spend a minimum of 90 days or more in the current year, and you've also spent a total of 365 days or more during the 4 years immediately preceding that current year.
Ah, that's clever. It closes that potential loophole for, say, the winter-only crowd, who might spend a significant chunk of time there each year, but never hit 183 days in any single year.
Exactly. It looks at a longer pattern. Now, let's look at charitable purpose in Clause 43. This is obviously crucial for nonprofits, NGOs. The standard things are included relief for the poor, medical relief, education. But the limitation is on the category advancement of general public utility. That's key.
Okay, where's the catch? What makes a public utility organization lose its charitable status under this definition?
It loses that status if the entity engages in trade or commerce, or if it provides services for payment for consideration, and the total value of that payment exceeds a certain threshold in any income year.
And that threshold was one of the big changes in the 2024 Finance Act, right?
Yes, it was. The Finance Act of 2024 increased the allowable limit for that kind of revenue-generating activity quite significantly. It went from taka 20 lakh up to taka 1 crore.
That's a five-fold increase. That must be a significant relief.
It likely is, especially for medium-sized nonprofits and NGOs. It gives them a much wider margin for fundraising activities or service provision before they risk crossing that line and potentially losing their tax-advantaged charitable status. The line's still there, but it's been drawn higher and arguably clearer.
Okay, so the structural definitions are settling in. But even with these clear definitions, the system is only as good as the administration built to enforce it. Let's shift gears and look at Section 4. It outlines what? 15 classes of income tax authorities?
Hmm.
From the National Board of Revenue, the NBR, right down to inspectors of taxes.
Yeah, it's a deep hierarchy, and that itself suggests a highly centralized and organized enforcement push. What really stands out, though, are the specialized roles created, roles that have distinct functions clearly designed for internal oversight and investigation.
Two roles jump out at me. They sound like they're meant to, well, add some teeth to the NBR's bite. First, the Director General Inspection. What's their job?
They seem to be the internal auditors and potentially the reformers. Their mandate isn't just inspecting tax proceedings. They are explicitly tasked with proposing tax policy reforms and identifying areas where the administration itself can be improved. So they're looking inward to make the system work better.
Okay, internal focus. And then there's the, let's call it the enforcement muscle. The Director General of the Central Intelligence Cell, the CIC, dedicated intelligence teams. That sounds effective, but is there a risk of overlap with other existing law enforcement, or is this just formalizing something that was already happening informally?
It feels more like a formalization, but with real teeth added. The CSC's mandate is very specific.
Yeah.
Carry out intelligence work, analyze that intelligence against actual tax records, and detect tax evasions and concealments of income. And crucially, that 2024 Finance Act really solidified this structure by adding corresponding ranks directors, joint directors, deputy directors, assistant directors to the CIC. This gives it dedicated manpower and the explicit power to recommend prosecution. It's about professionalizing tax crime investigation within the tax authority itself.
Right. That ensures a much tighter loop between intelligence gathering and tax action. Now, regarding control within this structure, the NBR can delegate its powers down the chain to subordinates, presumably to streamline daily operations.
Yes, they can. But there is an attempt here at a clear separation of powers, at least on paper. The NBR is specifically restricted from issuing orders or directions that would interfere with the discretion of the appellate functions, like those carried out by the Commissioner Appeals or Additional Commissioner Appeals.
Oh, okay.
This aims to protect the functional independence of that internal judicial review process. Keep the appeals somewhat separate from the initial assessment or investigation side.
Speaking of appeals, let's wrap up with the highest internal tax court, the Taxes Appellate Tribunal. What are the standards for membership here? They must be exceptionally high, given the complexity of the laws they're interpreting.
They are quite high, yes, designed to ensure serious professional depth from different relevant backgrounds. To be appointed as a member, you generally need to be, or have been, a member of the NBR itself, or a current or former district judge, or a current commissioner of taxes.
So, top-level legal minds and senior tax administrators. What about people coming from the private sector or legal practice?
They're included too. You can qualify if you're a tax practitioner with at least 10 years of professional practice under your belt. Or, interestingly, if you're a professional legislative expert with at least 10 years experience specifically in drafting financial and tax laws.
That's quite specific. Legislative drafting expertise.
It ensures a highly qualified, pretty balanced body, theoretically capable of handling complex tax litigation from multiple angles.
And how do they actually operate, make decisions?
Well, the powers are typically exercised by benches, usually consisting of at least 2 members. And there's a critical structural rule. At least one member of every bench must be either a current former NBR member or a current commissioner of taxes.
So ensuring that deep administrative and technical tax experience is always present in deliberations.
Exactly. Decisions are made by majority opinion.
And if the bench members disagree, if there's a tie, say, on a 2-member bench.
Good question. If there's a difference of opinion, the point is referred to additional members of the tribunal. The final decision is then made by the majority of all members who heard the entire case, including the referred point. In a very specific situation of a 2-member bench deadlock, the government actually has the power to appoint an additional member just for that case, specifically to break the tie and ensure the case concludes.
That shows a real intent to prevent legal gridlock and uncertainty.
Definitely. Finality seems to be a priority.
Okay, so we've mapped this massive overhaul from its, frankly, necessary constitutional foundation due to that voided 1984 martial law ordinance, through the immediate structural shifts made just this year in 2024, to the really precise definitions of everything from residency and, crucially, income, right through to the new enforcement architecture, including that powerful central intelligence cell.
Yeah, and for you, the listener, what this reveals is a system definitely in transition, but one with a very clear trajectory. The Act of 2023 isn't just an update, it's a highly intentional legal tool. It seems designed to capture unexplained wealth much earlier, right at the acquisition stage, and to centralize enforcement through these dedicated professional intelligence units. The era of maybe vaguer definitions and reliance on quite antiquated law seems definitively over.
That centralization and specificity are hard to miss. Now, for one final provocative thought for you to mull over. The definition of company in this act, Clause 31, is astonishingly broad. I mean, it includes the usual suspects, banks, foreign liaison offices, permanent establishments, but it also explicitly pulls in social organizations, cooperative societies, and even educational institutions.
That is broad.
So given the new law's explicit overriding effect over all other laws, what subtle shifts in legal standing or maybe administrative burden might this very broad definition impose on entities like, say, educational institutions that maybe previously enjoyed a distinct, separate regulatory status under specific societal or educational laws? Could this pull them more directly into the general tax regime? Something for you to explore on your own.